Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. It's the second week of December and many investors' focus has already shifted to what 2023 will look like in markets. However, this is also a good time to reflect on the past 1 year and how it sets up us both for the rest of December and as a starting point for 2023. To do this, today we have Manpreet Gill, our CIO for Africa, Middle East, and Europe in the hot seat, and have him answer rather than asking the questions for today's podcast. Hi Manpreet. 2022 has been a tumultuous year to say the least. What are your key takeaways?
Hi, Zhong. It's been tumultuous indeed. 2022 will most probably be remembered as the year when central banks, particularly the Fed, stamped their authority on markets with a force we haven't really seen in decades. Investors, of course, started the year loving stocks, cryptocurrencies, and all things that were fueled by relatively easy money. But of course, that was being a little oblivious of the danger that we're now better aware of caused by the post-pandemic spike in inflation. And of course, we're now at the end of the year with investors at a widespread level instead loving safer assets like cash and bonds. Now, this contrast from risky assets to more defensive ones captures a lot of what changed through the year. More importantly, we'd argue that one of the most rapid hiking cycles in decades was key to ensuring that while inflation is currently running close to 40-year highs in major economies, the long-term inflation expectations have actually ended up being fairly subdued. Now, the battle's not been fully won yet, but we'd expect that we'll know fairly early in 2023 whether central banks are sustainably winning the battle against inflation, and in doing so, setting the stage for what may end up being the next cycle in risky assets.
Well, as you said, the year isn't quite over. In the remaining weeks of 2022, what should investors pay attention to?
Well, in the remaining weeks, and indeed next week, there are a couple of events that we think will be a key input into setting the agenda for next year. In the US, we of course have the November CPI inflation report due on the 13th, and the last Fed meeting for the year on the 14th of December. Now, we expect the Fed to remain hawkish, especially after what's been another stronger than expected US jobs report and a surprisingly strong US ISM services data point. Now, financial conditions have actually eased a little bit recently. That, of course, caused by the pullback in treasury yields and the jump in equities, which in turn followed Fed Chair Powell's signal that the central bank may be starting to slow the pace of rate hikes starting in December. Now, what this means actually, in our view, is that although the Fed is indeed likely to, slow the pace of rate hikes to 50 basis points after what's been 4 consecutive 75 bips rate hikes since June, Fed Chair Powell is most likely to sound hawkish, and that may be key to, of course, keeping financial conditions, relatively tight. And the one point we'd of course be watching alongside the Fed more than the rate decision and Chair Powell's comments will also be, how the Fed's forecasts evolve, particularly on the terminal rate, where we'd look for that to be revised to at least 5%. That's in the US, of course, but over in Europe, the European Central Bank, too, is likely to raise the deposit rates by 50 basis points and sound hawkish like the Fed, despite signs that the euro area's economy is likely entering a recession. Now, inflation's still at about 10%, which is clearly too high for comfort. But despite that, though, longer term, we do expect the ECB rates to peak a little bit lower than market estimates at around 2.5%, because those recession dynamics may ultimately take precedence.
Well, not just the central banks, right? We also have more easing of mobility restriction in mainland China.
That's absolutely right. I think when we're looking towards the next few weeks, that's the other sort of significant event we're seeing, where in China, mainland China, there has been the start of significant easing of mobility restrictions across major cities. Now, we'd see this as a major step towards more normalization of economic activity. And we've also had, of course, this follows the recent series of supportive policy measures, particularly towards property development. Now, all of these, of course, coming ahead of the Central Economic Work Conference next week. And, in aggregate, they do support our view that economic growth in mainland China will likely recover to close to about 5% next year. That, of course, is looking at the next few weeks, and from a broader perspective, we'd expect to see more sort of targeted stimulus measures to boost investment going into 23, not only in more sort of advanced technology, but also in green energy infrastructure.
Well, we are putting out our 2023 outlook next week. Could you just offer us a sneak peek into your thinking for the markets next year?
Sure. Well, I'll give a bit of a teaser. I think the starting point, of course, has been quite key. 2022 year to date, of course, has been, as we now know, one of the worst years for U.S. government bonds and stocks in 150 years. But that kind of starting point, though, does mean that the coming year will likely provide one of the best opportunities to rebuild diversified portfolios. Now, regular readers over the years will know about our love for acronyms at the CIO office. And looking ahead to 2023, we're basically looking for rebuilding a safe foundation. And in that acronym, of course, S, we're looking to secure our yield. And we'll discuss opportunities, of course, in asset classes like multi-asset income, high-grade bonds, and high-dividend yield equities. On the A, of course, we'd allocate to long-term undervalued assets. And in particular, of course, we'll sort of get into why we think some of those sit in Asia. F, of course, is about fortifying against further surprises. And we would, of course, discuss ways we could do that through diversified allocations that, of course, still include cash and gold and potentially higher than benchmark government bonds. And, of course, on the E side, expanding beyond traditional assets through alternative strategies. Now, of course, SAFE, is just the headline teaser. We do expect to publish our 23 outlook next week, and we'll also be releasing a series of podcasts around our views in that. So please do keep an eye out for those when they get published on this channel.
Thank you very much, Manpreet, for this 2022 wrap up and also the preview of the CIO Office 2023 views. Well, clearly, 2 to 3 key events that could define whether Santa Claus rally continues to year end or take a pause. Of course, the key thing to watch for, of course, is the 2023 Outlook due next week, as well as our podcast series that will be releasing around that. It's a short one this week, but we promise to deliver a much lengthier one in the following weeks. Thank you so much for joining us today. Wish you a good weekend and a wonderful week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.